Hey, Max and Michael. Thank you both for taking the time to be here today for our IPO Readiness conference. I'll start with Max first. Max, I've known you for over 10 years. One of the things that strike me that's different about you is that you're very principled. The operating principles that you created when you found the firm was to define a company beyond commercial aspirations, and you want to determine what business to follow from core value, what follows it and what doesn't, and that helps you and your team to make business decisions. As a founder, you've talked a lot about the importance of sticking to your mission and building truly honest products and no hidden fees. Lastly, over the years, we have chatted about your hard, valuable, fun HVF philosophy, and the first question I have for you is that how do you keep it all up as a publicly traded company, where as you're getting ready to go public, where there's a lot more scrutiny on your projections, on your progress, which business will drive what revenue and contribution margin, how to deal with public investors who can care a lot more about numbers and scrutinize you accordingly while still be able to maintain those principles.
Great question. I think generally speaking, I sort of learned this lesson a long, long time ago, and it's super brain dead simple. But basically, if you just repeat the same thing over and over and over again, it becomes harder and harder for other people to say, "Hey, let's question this truth and let's do something different." So I didn't just write down the operating principles when I started the company. I published them, and then I proceeded to beat our early team over the head with them, and then the larger team and the larger team. And at some point, it became so endemic to sort of how the company runs and how it operates that it became self-reinforcing. And it sounds like a joke, but it's actually it was by design. The purpose was this: if one day a bus hits me, or I decide that I need to move to Mars, or something in between, you don't want the CEO, who is founder CEOs typically are culture carriers and kind of the source of the settings of how the company operates. At a certain scale, it's no longer okay for that one person to be the only linchpin. And so what I really wanted to do is to make this a sort of thing where not only everybody knows it, but everybody believes it. And so I made a big show in the early days by saying, hey, if you don't agree with this, leave. Like, it's okay. You do not have to be here. But if you are, you better know that this is the rules and we're not going to break them. We're not going to compromise. We're just going to be very, very black and white on these topics. Other things up for renegotiation. These, five things, core values, operating principles, they're not up for any kind of a bending. All the way down to, if I leave or if I stray, if I decide that I'm just gonna, this one time, I'm gonna do some deferred interest because it's really profitable. I want the team to get the pitchforks out and get me out, and replace me with someone who actually sticks to his guns. And that provides the best cover as a publicly traded CEO or as a private company, whatever. If I step aside from what we set out to do, my team won't support me, and everybody knows it. Every one of my directors, every one of my shareholders, every person that
Michael's smiling.
that is the intent. I want to be overthrown as the benevolent dictator of Affirm if I step away from the philosophy that we had set out to follow. On the flip side, I expect people to bring their best, smartest, most creative ideas around working within those principles and coming up with profitable ideas. We're not a charity. We're not trying to make anything but a very, very profitable capitalist enterprise. But it's different than doing it at the expense of the principles. And so you want the foundation of the company and the superstructure and all the new people and all the growth to be fully aware of the fact that this is the only truth that we're willing to follow, all the way down to no one is safe if they choose to stray from it. And you make it very clear in my founder's letter in the S1, I
Yep.
did the same exact thing. Said, hey, here's how we're going to do this. If you don't like it, don't invest. Please keep away from our shares. But if you do, we welcome your support.
Right. Taking a more cynical or Machiavellian view of that premise, because everyone in this business before you guys come along made money through hidden fees, deferred interest, and whatnot. So by doing the right thing, you got to get something else back commercially as well. Otherwise, this won't work. It's just a nice fairy tale. One of the things that Mike and I were talking about is that where buy now pay later is at now in terms of industry development feels almost like e-commerce itself or Amazon back in 2003, 4, 5, where there are two penetration rates that matter. One is in the US, e-commerce penetration is at 20%. In some other select big markets around that penetration rate as percentage of retail. And then in many other markets around the world where the next billion users will come from is somewhere in the low teens. And that's one set of e-commerce penetration rate you can follow, how big e-commerce will be over time as a percent of retail. With buy now pay later, there's another set of penetration rate, which is what's the percent of e-commerce transaction that's on buy now pay later, and that's in low single digit right now. So when you multiply those two numbers together, wow, you can afford to be honest and good because it's a massive opportunity ahead of you. It's easier to be good. Easier, I wouldn't say easy. It's easier to be good when you have just a huge TAM and only a few players can be effective in it because you need a lot of data and risk modeling to make that work. So you have the ability to be good because you have the right fundamentals that's underpinning your growth. Is that a fair assessment?
I think that's the right state of play today. There's very, very little coverage. And so we're not mostly competing for the marketplace against someone else. We're still trying to convert consumers to this way of life. We're still trying to persuade merchants this is the thing to do to try to use a marketing tool. And so you're right. It's easy to be, clean because everybody who wants to flock to that idea will come to you. I think what we're doing though is we're investing in the future. Ultimately, at some point, this market will become saturated, just like all the other markets. Yep. And the big trend that we're riding, kind of even beyond finance and beyond payments, beyond everything, is this notion of transparency. And there's some bads to it too. Like if you look at fake news and real-time information proliferation, all of that is a side effect of being super connected, being always online. My watch will tell me what's happening if I fail to look at my phone, if I don't look at my computer. Like there's always a screen somewhere telling me here's what's going on. And this massive transparency goes hand in hand with things like if somebody screws you through late fees or deferred interest or whatever, you will find out. 10 years ago, be like, oh, I'm not sure. It's an unexpected fault. Right. We're so sorry. We overcharged you. We'll get it back to you eventually. That does not work today. Like you're like, hey, you hit me with a late fee I didn't expect. I hate you. I'm switching away from you.
Right.
And so in the long term, the seeds we're planting now is the reps with consumers and the merchants where we treat them right. We don't screw them. We don't do the things that used to be okay because they were hidden and are most certainly not okay anymore because it's all completely out in the open. It's actually kind of it'll be a new, different inning of that particular game. But when we are compared side by side with other actors, I think it'll be that much easier to be different. It's like, well, yeah, we're the only ones who didn't take advantage of you over the last 10, 20 years, whatever, how long we will have been operating by then.
Yeah. Another thing that's different about you guys, you have a number of very interesting partnerships, almost collectively put it together becomes a moat for you. You have partnered with Peloton. I remember that vividly when we made an investment actually in both companies as a result of seeing how well you guys work together. And then Walmart and Shopify, obviously most recently Amazon. But as a small company back in 2012, 2013, 2014, it would not be as easy to strike a partnership with the Peloton. Peloton is a more startup back then, but with Walmart or with Amazon. What kind of advice do you give to founders that you need to build moat, build alliances to be effective over time? But how do you get started? How do you balance going after the mass merchants versus striking strategic partnership at times? So they're time consuming. They don't always work, but you need enough of momentum, to get those done. Without that, you may not have the true moat. So how do you balance that, and how did you guys get to where you are?
So I'll tell you two stories. I'm not sure I have if there was a rule book of here's how you get a company off the ground by partnering, just so I would have read it and we would have been farther along. But unfortunately, I can't find that book even on Amazon. But I'll give you two stories: the history of partnering with Peloton, the history of partnering with Walmart. So Peloton, we were tiny. We had no merchants to speak of, and this woman who worked for us in very early sales was staying in a hotel, some very inexpensive hotel in New York, trying to close that one more deal. She found in a drawer like a leaflet, poorly printed one that said you can have basically a spin class in the comfort of your home. A company called Peloton was launching. And so she decided, well, yes, they haven't even launched yet. Like this was like a, hey, you can come see our showroom before we put it on sale. She went there and was like, hey, these are going to be expensive bikes. You guys are going to have to sell some financing. So the
Smart
punchline
organization.
there, it was brilliant. I remember asking like, who found this company? They're growing like nobody's like. Yeah, Alexis was staying in this. At least the story I heard, she was staying in some hotel room. She found a leaflet. It was like, I should go find these guys.
Right.
And I think she was actually trying to strike a deal with Casper, another sort of flagship merchant,
Right. Of
10
course.
years running for us. And so she signed both on one trip instead of anyway. So like never let serendipity go unused. I think
Right.
that's the shorthand lesson there. Like if you see something that looks like just pull the thread, there's a big fish on the other side. The Walmart process was very different. So I had decided, at founding of the company that the mission was to not just do all these right things, but also kind of push the world towards ridding itself of bad things. And I sort of somehow triangulated that Walmart might be one of these companies. I never really dealt with Walmart management. I never really knew anybody there, but I'd sort of heard through a friend of a friend that like they run this company. There's very principled stance. Like the principled stance is part of the fabric of the company. Like, well, you know what? If I'm gonna like shoot for the stars and like be obnoxious, I'm gonna go to the biggest retailer of them all. And so somehow I got an intro
Only
to
Max
somebody.
thinks like that. But yes, point taken.
I don't know if that's
Or you
strictly.
can afford to think like that.
Not even. I didn't know anybody at Walmart. I never met any of the management team, but I got sort of interest through one person to another to the third, and eventually got in front of a relatively senior manager there, and basically said, "Look, guys, I think I hear that you're a principal stand kind of company. I'm a principal stand kind of entrepreneur. I think you
Aha.
ought to consider this thing." And so I think what worked there, and I'll finish in a second. That they sort of said, we've never really looked into all these core brand credit cards, and we have a bunch of these products. They're out there. We work with these banks, and that's cool. Like we know our customers want them. Said, well, let me try to tell you why I think those are not good enough. Like what we have is the best. Like this really is the principal stance. You should take this one. And I think for a time they're sort of like, who are you, dude? And like, yeah, you founded PayPal, but we're Walmart, so like, okay, cool. But after a while, I was super persistent, probably extremely obnoxious, but I kept on calling this guy Daniel, who was my counterpart at Walmart. He's like, look, man, like you just gotta like, let me tell you more about it, how much deferred interest is terrible and how the right thing to do is what it is. And so at some point he's like, I'm going to look at it very, very seriously. And then within a few months, he called me back and said, you know what? You're right. Like you were right all along. We looked at this very deeply. We are going to make a hard stance and say no more deferred interest. We cannot partner with companies that are deferred interest because it harms consumers. Not only are we going to do this, we're going to publicly state that. So they published a blog post with this guy Daniel Eckert signing off on it. Basically, we've looked at these products and we think this is a bad one. We don't want it anymore. We're going to completely divorce ourselves from any of these. And that was the beginning. Like they didn't say, and therefore we'll go with Affirm, but just beating up on the we are made of something that's different and important, and a company this big and this important should care. It took probably 3 years, but at the end of it, we've had a wonderful relationship with the entire management team. And by then, I had met the CEO and sort of met various senior people there, and every one of them I found to be just these really good, caring people that wanted consumers to get what's right and better. And once they knew what we're all about, they trusted us over course of a few years. It was a great partnership, and it was fundamentally and absolutely rooted in the operating principles and the values of the company. And it was not about let us do something, buy the business or do something extremely contortionist. It was really fundamentally about just connecting at the level of what's right. And so I believe that principal stands are good for business as good as they are for team building.
Okay. Makes sense. One more question on partnership. You've been able to work with Walmart, Shopify, Amazon, and all kind of competing against each other in one way or another. How do you make that work and be able? What is the one or two things that you guys did or have that allow you to have the ability to work with people that compete fiercely against each other?
So it actually goes back to the first question, or all the questions you just asked. So the way we approach merchant partnerships, and this is, those are sort of outsized examples, but we power vast majority of connected fitness category online, and those are very competing merchants. It's sports. It's not war. They don't want each other to die, but they want the other guy to lose a customer so they can win a customer. So it's an aggressive, very, very heavily competed category. The same true for homewares. Like every mattress online is probably financed using Affirm.
Sure. We're talking about
And
Walmart, Amazon, Shopify, very big companies now.
but the point is, how did we convince all these companies to play with us while competing with each other? What we did each time, and this includes all the big brands you mentioned, we showed up and said, look, we're completely transparent. We're going to make commitments and you'll be able to audit them. We're going to show you our entirety of economics. So there's no hidden anything. Like we will tell you exactly where the revenue is and where it isn't. And so we will also take the same stand on what do we do with customer data? What do we do with the information we gather as a result of the relationship? So on and on and on and on. And ultimately, if you can trust us to treat you right and trust us to treat your competitors right, part of it involves making sure that where the walls have to exist, they do exist. And we will never breach that trust for anyone. And I think part of what all these really big companies did is they said, well, in the situation where they service multiple competing companies, how do they treat them? And time again with their diligence, they say, oh yeah, they are able to treat every one of their partners fairly without conflict. No one has ever left us because we did something special for the other guys. And being a payments network requires you to be ubiquitous. Otherwise, there's no point. Like if you're either a specialty provider or a ubiquitous network, we're very much in business of building a ubiquitous network.
So what you're saying is that being good and honest and transparent is not just because you can afford it. It actually makes good day-to-day running business.
I think that's the only way you can do what seems like magnanimous decisions as a business leader is when it's good for business. I think if you fundamentally say, I'm going to restrict myself from doing something, but I really, really want to because it's good for business, but I kind of have to look a certain way. Like you're just waiting for that thing to crumble. You say, look, I don't really care about this issue, but I know it's important. It's top of mind right now. So I'll just say something out loud. Like that evaporates overnight. So I despise lack of authenticity more than anything in the world. When people say, oh, I really, really care about this, but when the doors close or the microphones turn off, they're like, I don't really care. Like, all you're waiting for is a hot mic. Someone's going to hear, and then it's all just going to crumble.
Fair enough. One last question for you is, one of the most important strategic decisions you made, and we chatted about this back in 2018, was that when you go direct to consumer, and you guys launched the Affirm app, and now can show all offers from all the merchants you work with on one app. And in the IPO perspective, disclose that a huge percentage of GMV, a material percentage of GMV now comes from the Affirm app itself. What was the thinking process, and how did you end up having the conviction that this is the right strategic move for you?
So, vast majority of successes in my entrepreneurial life are happy accidents and sometimes stupid accidents. This is no exception, and I have lots of other ones, but in the interest of time, I'll stick to this one. So we were building a way to connect to some ancient, I'm not going to disclose the retailer, but this particular retailer has a payment stack so old, they don't really have the code anymore. They just kind of lost it. And so it works, but they can't change it. So they basically said, look, we would love to use Affirm. We want you guys to be on our site and in our stores, but we're not really going to integrate with you. Like you have to bring us something that looks like a 16-digit number. I said, all right, well, that means I have to create 16-digit numbers on demand, basically credit card numbers, and push them into your web form. Like, okay, we're engineers, we'll build anything. So we did. And so as we were building it, we said, well, this is kind of a cool idea. You want to take an Affirm loan, but express it as a 16-digit PAN. Like, why don't we build a demo and stick it into our app? And so we did. And so suddenly Affirm was available anywhere. Like, we have to go through this painful process of typing in 16 digits. We launched it and just told our users, hey, we have this cool thing now. Like, if you want to use Affirm at, name a retailer where we're not, you can just apply inside the app and we'll give you a number. And it's kind of a pain, but maybe it'll be helpful to you. And it exploded. So as soon as it started growing like this, we're like, okay, so clearly this idea of like, I want to use Affirm everywhere, not just where Affirm sales team has gone and succeeded, is pretty good. So it's about a third of our transactions now. So this is more than a low material. But it was not part of the plan. We just sort of did it and it stuck.
So always be aware of what could go right. Even if it's not intentional, when it happens, take advantage of it. Very important lesson. I'm going to switch to Michael. You joined Affirm over 3 years ago, having spent 6 years in enterprise at HP. How did you decide that Affirm is the place that you will want to go? One, and two, that you actually succeed at this.
Yeah, the second one was harder because I didn't know. The first was easy. So I'd spent better part of a decade with HP and its children, and then before that, I was at KKR. And if you think about some of the other end of the spectrum, vis-a-vis Max's mission and orientation, I'd seen it. And when I got to know Max, it was both his vision for the company, this intersection of technology, retail, and finance that was so interesting to me from my background. But also, I knew that we were going to come here and get to do something pretty interesting. I was at a spot in life where I didn't want to work anywhere where we weren't going to change the world, and this was a chance to do that. And I thought at scale. As for my success, I don't know. The jury's still out on that one.
So, in terms of advice you would give to other CEO who's looking for someone like yourself to help them, what should they be looking for? What kind of questions do they ask their CFO candidates to make sure they can find a Michael?
Again, not sure that's the goal, but I think it's really important. And this is something a lot of board members I talk about, but the relationship between the CEO and the CFO is a very unique one. It is both one that is supposed to be one where you can disagree with somebody. I was smiling earlier talking about Max, and I feel like I can hold him accountable and he can me. But it's also one where if you're not aligned, it'll show really fast.
Right.
So I think the most important thing is to ensure that the CFO that you bring on board shares an orientation around the vision, the mission, the how, the what, all of it. And that you've got to have that alignment. And if you're ever doubting that, it's probably not your person, because you're going to have to defer to them. You're going to have to trust when they push back. It's not coming from a lack of alignment. It's coming from a real concern. And you're going to want to be able to push them out and, rely on them when you're not around. And so I think that deep alignment is really important. For me, that's, actually liking spending time with Max, and on a personal level, it's both of us being able to recite most of the Big Lebowski and take ourselves not too seriously. That's really important stuff, because there's plenty of moments that are going to be tension filled and high stakes, and you want to have someone on your side, I think, who you can trust and you like spending time with.
What are in order to be a competent, if not successful CFO, what are some of the key attributes or skills that you think are very important for a first-time founder to be aware of?
You need to know your numbers. I think it's really important to know the inside and out and the mechanics of how the business operates as expressed through the financial statements. When you're a private company, I'll be real honest with you, no one cares. When most people look at the financial statements and they kind of throw them in the side and they're like, that's interesting, but look at my sexy keynote slide with the big growth.
That's right.
That flips when you become a public company. It's all that people look at.
That's all about numbers.
And so, I think it's really important that a founder understands that pivot doesn't happen overnight, and you want somebody who can do that for you and with you. And you don't want to have to shoulder that burden all on your own, and you need to make sure that the CFO can dig in and really get it. For our business, it has a bit of a complicated set of financials. It was doubly so. But I think for any business, it's important that CFO really understands how the things that you do, decisions you make commercially, investments you make in the business, express themselves in your balance sheet, in your income statement, in your projections, that the things that you're doing result in the scorecard that you publish looking the way you want it to look.
Yeah. Some of the founders we meet, they have raised billions of dollars. They feel they're ready for public because they've been tested already. But kind of give some examples how the public investors just test you at a different level. What are some of the anecdotes you can share?
Well, okay, so there's, I think, two things to think about. One is, when you're private, you can share anything you want, and you are largely unconstrained, and your story is your story, and you can pull data points, and you can selectively disclose as you'd like to investors to get them on board and understanding your story. When you become public, there's a whole bunch of really restrictions that you have to live with. And so what that means is you have to be more thoughtful and calculating around how you share information with your investor base. The other thing is, I felt like with our private investors, we got to know them well, and they got to know us really well. Most portfolio managers are not managing a couple of investments and spending a lot of time with the team. They are, on the public side, flying very, very high and managing lots of investments. And so the challenge that it's like you can't share everything anyway, and you only get so much airtime to get your message across. And so an investor will get stuck on something, and you need to be able to get them off of it and understand the answer to their question very fast, not over the course of many meetings like we would do in the private company context. And again, you're expressing and communicating so many things through these formal channels, earnings and guidance and the script, the obsession over all that stuff. It's really important that you're thoughtful about that, because on the other side of it, those public investors rely on that to make their investment decisions.
What would be the advice you give the founder and the CEO? How far in advance they should be hiring a CFO to help them prepare for an eventual IPO?
Well, I think as soon as you feel like that's a likely thing to happen. I told Max when he was recruiting me, we had a dinner. I said, "Well, I'm not taking you public. That's not going to happen." And he's like, "Don't worry about it. It'll be fine." And we needed that. I needed that year or so to really understand the business before I could even take us on that journey. Mm-hmm. And I think if we thought that we were going public earlier, we probably couldn't have invested that time. But for us, we did have the time, and we were going to do it at the right time. I think IPO readiness, I hope this doesn't run against some of your themes you want to talk to your teams about, but I think IPO readiness is a bit of a lie. I don't think there's any prep work you can really do to truly be ready. And I don't know how, in a high growth private company context, you can invest the kind of trade-offs you'll invest for a potential IPO. So real example here. My controller is phenomenal. She's one of the most brilliant accounting minds on the planet, and super excited to join the journey on taking us public. And about 2 years ago, I put IPO readiness as one of her OKRs for the year, and we were going to talk about IPO readiness, and it was put at the top of our list. And she started doing work on it, and then COVID happened. And if you can imagine the priority of getting the company public ready when we were facing what we thought was a major threat to so much of what we did, it just fell to the bottom of the list. And I think that's a thing that every company will eventually do. So the first thing is you'll never really be ready. Some of IPO readiness is getting conviction around what you want to do and then bracing for what is a very intense sprint to take yourself public. And it's while you're going public that you'll become ready. And there's some things you're just never going to be able to pull off on the front end. And so don't hold yourself to too high of a standard. And the same thing is true even after you're public. A lot of IPO readiness happens post being public. And that's okay. And don't hold yourself to the standard of, now that we're public, we got to take ourselves seriously. We have to fundamentally change how we think about things. Yeah, the rules change. And yes, the expectations are different. And your performance is expressed in the stock price, which is a distracting thing. And there's all this stuff happens around it. But really, at the end of the day, you're running the same company, and your mission doesn't change. You need to go build your company, delight your customer, in our case, our merchants and our consumers, delight the people who pay you, and continue to build your business. And that the public-private status has nothing to do with that part of it, and you just can't forget that and get trapped in the public company. Oh, we're important now, so people got to pay attention to us.
What are some of the more important key members of your finance team that help you and work with you to get the company ready for going public and be able to perform well afterwards?
Yeah, I think you've got to have an outstanding controller. And I think so much of the IPO process is about the financial statements and the associated disclosures. And if your controllership function isn't really good, you got to invest in that early. And then I think you need a really strong FP&A or strategic finance team, because for the first time, you'll be making projections that you'll actually be accountable for. Respectfully, private company projections are sometimes beautiful up and to the right charts. And it isn't the case that most private company investors are coming back and moving the value up and down in every 3 months based upon what you tell them you were going to do and what you did. And so having a high degree of reliability in your business and being able to forecast it accurately is really, really important. It's also important to make decisions because you're going to be sitting with your CEO and your executive team talking about where you invest. If you can't predict where that takes you, you're just going to be flying blind. So controllership and FP&A or strategic finance are really, really important to get in place and get in place well. We didn't do. I screwed a lot up. I made a lot of mistakes. We didn't get investor relations on board until well after we were public, and that was a mistake. It's hard to think you need it because you're operating in an environment where you think, oh, I'll deal with that later.
Right.
There's so much to do in the IR world. So the other thing to do, I think, is to try to get somebody to help you be there as you're preparing your S1, as you're going through your first earnings process. You want someone there along the whole way, because something that we talked about earlier, and Max put it really well, the conversation you're having with investors, private or public, should be consistent, and it should just be the same thing in layers and layers and layers, because you're never going to tell your whole story in 10 seconds. And so if you can bring some of that consistency in message and tone and approach, it pays off, because eventually light bulbs go off for investors. They say, oh, you keep telling me this matters. Oh, I see it. This really matters. And that kind of consistency is hard to get if you're changing your team out too much. And so I think having some longer term IR probably would have been smart for us.
Okay, sounds good. Thank you for your time. My takeaways are, if you have a great operating business principle that you can count on, everyone understand, in a market that's going to be just huge and massive with only like a 1% penetration rate, and hire a smart CFO who knows about numbers better than you do, with a team underneath them or her that can support that mission. Great controller, great FP&A, and very good IR. You got to have all that before you try to go public. And if you can do that, you will be like Affirm. So thanks a lot for your time. We really appreciate
it. Just like your opinion, man.
Everybody wants to go from 10, 20 million pre to become 25, 30 billion market cap company in the span of less than 10 years. So it's a good model to follow. Can't go wrong. All right.
Thanks,
gentlemen.